Hello and welcome to the Commonweal Policy Podcast. I'm Craig Dalzell, I'm the Head of Policy and Research at Commonweal, and this week I'm joined by a very special guest. Welcome to Professor Richard Murphy from Tax Research UK, Professor of Accountancy at Sheffield University and a tax justice campaigner. Hello Richard, how are you doing?
Hi Craig, I'm very well. It's good to be here.
Thank you for coming on. In the several years we've been doing the podcast, I think this is your first appearance on the podcast, and for someone who everyone in Scottish politics is talking about, that's a mistake I'm glad to rectify this week.
Yeah, look, I've even been in the studio in your offices, and I've still not recorded for you before. So how about it? We're going to do it from a distance instead.
Yeah, so Richard has had quite a long involvement in working alongside in the same direction as Commonweal. He's written a paper for us on tax in an independent Scotland. He has recently updated that paper for the Scottish Independence Convention's transition series. I'll link to both of those papers in the description to this podcast. But this week we are here to talk about probably the biggest piece of global tax news, certainly this year, if not ever, because it's in terms of the philosophy of tax, probably is a really significant move. We're talking about the agreement between the G7 nations to have a global corporation tax. So, Richard, can we start just by talking about the history of this idea and how it came about?
Look, that's an open-ended question. That one is, because there could be a very long answer. So I'll try and make this a pot of history. Since around the turn of the century, it's been apparent that the world's corporation tax systems aren't working with regard to multinational companies. The problem is actually fairly straightforward. We think of multinational companies as single entities, in other words, one company. Whether we're thinking about a bank, whether we're thinking about an oil company, whether we're thinking about a tech company, we presume that Microsoft is, for example, one company, but it isn't. It's made up of hundreds and even thousands of different companies, and they are all located in different countries, and the tax is paid in the countries where those companies are. And how that multinational company allocates the profits between the different companies within its group has a significant impact on the overall level of tax it pays. So if it can allocate its profits to low tax countries, and here we're talking the zero tax countries like Jersey, Guernsey, Cayman and so on, or the low tax countries where we're talking about places like Luxembourg and Ireland, the Netherlands, which most people don't think of, but it's very definitely a tax haven, and Singapore, then they can reduce their overall tax rates. So there have been moves to try and tackle this issue. None of them were very successful until, first of all, George W. Bush was removed from the White House by Obama. And then, because of the global financial crisis, the pressure for change grew. There's been one previous major go at solving this problem. It was announced, bizarrely, and just as this one was announced, in the UK, it was announced by David Cameron at the Lochern G8 summit in June 2013. And I was there, literally inside the sealed off area, sitting right in front of David Cameron, 2 rows from the front when he announced it. I literally was in the room and very close to the negotiations at that time, invited by Downing Street, because it adopted something called country by country reporting. And it was the first time that companies had to report their results to their tax authorities, saying how much activity they had in each country where they operated and how much tax they paid. So it gave them a clue as to whether there was a real problem or not. And that was the accounting system I designed. It's now the law in over 70 countries around the world. Well, what we discovered from that data, which we now have, is that there is a problem. There really is still an ongoing issue that companies aren't paying the right amount of tax in the right place at the right time. So the OECD, the Organization for Economic Cooperation and Development, which you can succinctly call the rich countries club of the world, was basically forced to go back to the drawing board and say, right, we now need round 2. And it's round 2 that we are now talking about. Well, they tried this for a while, but there was another impediment to progress, just as George W. Bush was the impediment before Obama came along. Well, Trump was the impediment before Biden came along. Biden has changed the whole game. But let me just explain what the game is. There's two elements to the negotiation, effectively. The first is the tax in the right place? Is the profit in the right place? Is the tax being paid in the right place? That, in the jargon of these negotiations, is called Pillar 1. Pillar 2 is the tax rate okay? Is the tax rate too low or not in the country where the profit is? After we've done a reallocation, maybe under Pillar 1, is the tax rate still too low? So then we end up with a thing called the minimum effective tax rate calculation, and that's called Pillar 2. So that's what we're doing. We're still trying to put right an international tax system that is, well, frankly, still not very fit for purpose in the 21st century.
Right, so yeah, that's great little potted history, and you can see how it is a bit broader than maybe the just that headline of minimum tax rate that has really gone around that Pillar 2 side. Do you think the Pillar 1 is perhaps the bit that we should be talking a bit more about, is how that reallocation takes place?
If I had my way, Pillar 1 would be quite significant. I would actually basically require that all multinational companies, I would, by the way, apply this to all multinational companies, not just to the very large ones who are going to be caught by this process, because this is only going to capture companies with turnovers of more than about $750 million. So yeah, most companies are not going to be impacted on this, including many multinationals. I would have all multinational companies basically have to declare their information on a country by country basis, this accounting formula that I used, and then we could check, do they allocate their profits to the right place? And the right place would be determined by where are their customers, where are their employees, and where are their real production facilities? Even banks have production facilities, by the way, places where their people and their computers are at the very least. So everybody's got some sort of production facility, and you can create a formula to actually allocate the profits to places on that basis. And I think that would create the fairest outcome for all multinationals. Now, that, by the way, has a really important Scottish dimension, because that formula is actually going to be really important to Scotland when the time comes that we're going to be arguing about the allocation of profits between Scotland and England, when Scotland is independent, and we need to have a basis for agreeing how profits are split between the two when there's only one company, call it Tesco, call it whoever you wish, who's operating on both sides of the border when we have it. So this is of real Scottish significance that we get this right. But at the moment, they've decided that this Pillar 1 calculation only applies to large companies, and in a very bizarre way. The company has to make a profit rate of 10%. Now, that's profits as a proportion of its sales. If it makes a profit of 10%, they say it's an exceptionally profitable company, and then any excess over 10%, 20% of that excess can be reallocated. Let me just put that into numerical terms. I've looked at Barclays Bank today. We're recording this on Wednesday, 9th June, and I've done a quick analysis. It's on my blog. Barclays makes a 14% profit rate in 2020. So the 10% is it can have that. There's no question about it. The excess 4% is subject to reallocation as to where its customers are going to be. Of that, only 20%, however, is reallocated. So 0.8 of the total sales, 0.8% of the total sales of Barclays could be subject to reallocation between countries. How much are we talking about there? Well, 174 million of profit could be reallocated. What's the likely tax bill on that? Well, 35 million. We aren't talking about megabucks, is my point. No. As it stands, this Pillar 1 calculation is not a particularly big deal, except for the tech companies, because they make around 25% profit margins, excluding Amazon, which is a retailer and not really a tech company. So Pillar 1 is not the big deal. The one that could have raised lots of money was Pillar 2, which is the minimum effective tax rate.
Yeah, and it was kind of publicized that Joe Biden went into the negotiations looking for a Pillar 2 tax rate of about 21%, I believe it was.
It was.
But he's been negotiated down to just 15%, which coincidentally is below the corporation tax rate of all of the G7 countries involved in the negotiations. The UK currently has the lowest headline corporation tax rate, and it would have been below that 21% rate. So is this a sign that this negotiation actually has a structural flaw in it, where you have quite a small group of nations, effectively pulling the floor up to just below where they already are?
Well, remember, this is an effective tax rate, not a headline tax rate we're talking about. So actually the tax rate would be calculated by country for each country in which a multinational operates to see whether the 15% applied. But the 15% is simply too low. The average OECD tax rate is around 25%. The US tax rate is going to be 28%. The UK's is going to be 25%, although we have some massive deductions which reduce the effective rate of tax. So why was it chosen? Well, I think because frankly Rishi Sunak wouldn't buy it, and so there was a compromise. It's only just above Ireland's 12.5%, which is seen as one of the the bad marks of the world. This is one of the countries you definitely don't want to be compared with is Ireland, and we're only just above it. So does this indicate that there's a flaw in the negotiation? Yeah, clearly it does. I mean, the negotiations virtually failed at the first hurdle. But remember, this is only the first hurdle.
Yeah.
Because there are many steps to go. In particular, the G20 is coming up in July. And this has to become a G20 policy before, frankly, the OECD is going to take it very seriously. The OECD, I've already mentioned them, the Organization for Economic Cooperation and Development based in Paris, actually will have the job of translating this into real detailed tax directives. They are effectively the real tax setters for the world in this sense. And I know their workings well. There will be long and hard negotiations. Nothing is going to come to a conclusion, and no tax is going to be collected on this, by the way, for at least 5 years, even if everything runs well. But the place where it will first not run well is going to be, well, this weekend's G7 summit, where somebody might have second thoughts. Rishi Sunak already is. He's actually managing to outdo the Northern Ireland Protocol on this one. He's actually managed to renounce an agreement he made within days rather than in weeks of signing it, which is a quite extraordinary achievement for British diplomacy. A new world record to actually renounce the deal you agreed at the weekend by, well, Wednesday. We'll come on to that, I think.
Yep.
But let's just talk about, will it get through the G7 summit? Now people have actually thought about it. I think so, but the G20 is another story. Because at the G20, there's going to be representations by China, there's going to be representations by India, there's going to be representations by Brazil, and South Africa will be leading the charge for the African countries who are badly affected by this. And they're all going to point out something which is really important, which is actually, let's go back to that David Cameron meeting I talked about in the G8 in 2013. It was G8 then because the Russians were still involved. He said that the whole basis, the whole reason for doing these negotiations on international tax was to help developing countries. Well, this deal does not help developing countries. This deal allocates the profits fundamentally. The vast majority of the profits collected, the extra tax collected, will be in the head office locations of multinational corporations. Yeah. And they are predominantly, well, New York, London, a bit of Frankfurt, a bit of Paris, but certainly not in Beijing, and certainly not in India, and certainly not in South Africa, and certainly not in Brasilia or wherever. So those countries, let alone the poorer countries, are losing out here. So they then have to go to the next stage and win the OECD's support, and there are 140 countries involved in that negotiation, many of whom are those poorer countries. So unless there's some degree of compromise about this deal, which gives more of the income to the poorer countries of the world and changes these formulas, both the minimum tax rate, but also this reallocation formula, so that more goes to them, I think, frankly, we are going to see problems in getting this one through. I doubt it will go through. These things gather a momentum that normally means they deliver something, but I don't think it'll be precisely what we've got yet.
Yeah, I can certainly imagine, for example, an American tech company that is channeling all of its tax through Ireland, for example. When those reallocations take place, what you'll find is the tech company mostly does its business in America, so all it's going to do is move the taxable profits from Ireland back to America. It's not going to the USA. It's not going to spread it around the developing countries.
No.
What has the reaction been for countries that have not been involved in the negotiations so far?
Well, actually, it's been fairly muted so far. We haven't heard a lot from the countries. We've heard a lot from politicians, particularly right-wing politicians, about this, but we haven't as yet heard much. And I mean, I've been involved with a lot of offline debates, if you like, around what's going on, listening to people in many countries in the world. The biggest message we've heard so far is that the right-wing politicians of the world are treating this as a gift. You wouldn't have expected that, because you'd have thought a minimum tax rate is not the thing they want. They're normally in favor of zero tax, but no, they think 15% is now the global minimum tax rate, and it is the tax rate that they should therefore apply in their countries. So already the Australian right wing are saying, cut our 30% tax rate to 15, because that's the global tax rate. And I'm hearing the same from Denmark. I'm hearing the same from Finland. I'm not hearing much from the actual tax administrations as yet as a reaction. I think that that's been fairly muted so far. And again, the international press is not raising many comments, but I think it will be coming through, because they're seeing the commentary that is happening around the civil society debate. And there is a good and very strong, informed civil society debate around this. And we do feed back into those countries, and they're going to be saying this deal is not good for us. So I'm pretty sure that there's a thing called the BEPS monitoring group. BEPS is Base Erosion and Profit Shifting, which is the name of the last OECD program. I'm a member of that group. There are around 25 of us in it. And we feed back information to the developing countries in the main, and they're not going to be happy with this deal. So I think there's going to be a lot of debate still to go.
Now, just to come on to the story you just alluded to that broke this morning, and I think probably gave us both a chuckle when we first saw it. This is Rishi Sunak trying to find a way of making global Britain not so global, and finding ways to exclude the City of London from this global tax. Can you tell us a bit more about what's going on there?
Well, I wish I did know more, and I have been talking to journalists since, well, early today. I think my first call was at 7:15 this morning. That's the trouble of tweeting too early in the morning. The journalists think you're up and therefore available on the phone. And that was from a pretty major newspaper saying, what is the story that the Financial Times have got? It does seem as though only the Financial Times were briefed that Rishi Sunak is unhappy about the deal he signed literally at the weekend. And the story is that he wants to take the banks out of this deal, because banks in the UK and in the USA, but not, by the way, very much in Europe, tend to have higher than 10% profit rates. So under this deal, where if you've got more than a 10% profit rate, part of your profits are reallocated to where your customers are. Well, Rishi Sunak seems to think that this is going to cost the UK money. So he now wants to have a carve out, meaning that the UK's finance industry will be taken out of the deal he signed last Saturday, and this is only the following Wednesday. Now that smacks to me of a number of things. One is incompetence. Why didn't he know that banks made more than 10% profit rates? I did. If I did, why doesn't he? Why doesn't someone in the Treasury at least notice? Why didn't they notice that some insurance companies, by the way, make more than 10% profit margins? And why didn't they notice also that some pharmaceutical companies do? I'll name one that we're all pretty familiar with right now. AstraZeneca made more than 10% in 2020 on its last accounts. Not much more, but it did make more. And, profits in pharmaceutical companies are looking pretty good right now for some strange reason. I can't think what that might be, especially if you're AstraZeneca or Pfizer and one or two others. So, there may be some unexpected companies caught within this net. Why has he done this? I really don't know. I mean, it's crazy because, first of all, as I've already explained, the impact on Barclays, the one I really looked at in some detail. I haven't had long enough to look at others, in between journalists and podcasters and others calling me today. But within that context, it doesn't look as though the amounts of money that are really going to be subject to change are that significant. So it looks like he's creating a bit of a storm in a teacup. And you have to ask, why is he doing that? And my suspicion is that there is a game being played here. I mean, first of all, there was a game played last weekend. The UK had to announce that the G7 Finance Ministers Summit was successful. Yes. They had no choice, because this is the first summit meeting in the UK post-Brexit. And Sunak had to say, aren't we fantastic? We've reached an agreement. Because the embarrassment of the UK not being able to put a deal in this first post-Brexit international summit would have been disastrous. So he agreed to virtually anything to some degree. Now he's realized that what he's agreed to isn't good. But, and I think here's the big but, the killer issue here is that 15% minimum tax rate. If that minimum tax rate was 21%, the amounts of money that would be raised would really be quite significant. We'd be talking hundreds of billions of pounds around the world. Plenty enough to pay, by the way, for entire COVID world vaccination several times over. In other words, we could make sure that everybody gets their top-ups as well as their first and second jabs and everything else beside, for the world at large. So this is a really significant issue in that sense, if that's how you think about tax. And in developing countries, yeah, tax does really pay for such things.
Yeah.
It may not in a modern monetary theory economy, but it sure does in developing countries. So my clarification there is important for those who understand modern monetary theory, but it's important. Now, therefore, there's real money on that one. And maybe what I think Sunak is doing is trying to put all his focus on this formula for apportioning profits, which is, as it stands, pretty irrelevant, to prevent people having time to discuss the second leg of the deal, which is the minimum tax rate, which he wants to keep at 15%, I suspect. Why do I think he wants to keep it at 15%? Well, two reasons. First of all, I mean, we were on a 19% corporation tax rate in the UK. Yes, he's announced it's going to 25%, but he's also giving away over 25 billion of tax relief over the next couple of years or so with regard to what he calls his super deduction for business investment. So effective tax rates in the UK are going to be nothing like 25%, whatever he says. And therefore, he's quite worried about maybe some companies would actually, go way below 21%, which is why he didn't want a 21% rate. And secondly, I think actually he frankly does still want to cut taxes. After all, the target was 17% not very long ago. And I once heard rumor that 15% was the target rate that the Treasury had. And I heard that rumor a long time ago. But for more than a decade, I think that's been their goal. So my suspicion is he is really very keen to have a big argument about an inconsequential issue, the profit apportionment, and draw attention away from the minimum tax rate, which he's very keen sticks at 15%.
Yeah. So let's say this idea isn't modified hugely. If what we know about it now is the thing that actually does come in a few years, it's been broadly accepted by everybody involved. We've talked about some of the limitations on this, but do you think it's going to have a big overall impact? Will it result in multinationals paying significantly more tax, or is it just going to be an inconsequential line in their ledger, or even are they going to find different loopholes to outright avoid it?
I am very worried about the loophole issue. Strangely, this isn't very much of a tax standard in some strange ways. I've already mentioned I did accounting on tax already, and that was a clear part of the 2015 OECD outcome of the first round of these negotiations was an accounting standard, country by country reporting. The thing I wrote to celebrate my son sleeping through the night in 2003. I am not kidding. I literally wrote it to celebrate my son sleeping through the night. It just demonstrates how bad a sleeper he was that I wrote an accounting standard to celebrate that. He's now studying accounting and finance at university. He was obviously destined to go that way. Now,
or didn't have a choice.
Yeah, he did. Yeah. He actually changed degree when he got there to study accounting and finance without any influence from dad. So I'm not claiming any credit for that. He actually decided it was interesting. Wise guy. Now, let's come back to the detail though. Yeah. This is all about accounting. We're talking about profit margins. We're talking about reallocations. We're talking about how do we attribute profits to countries. We're talking about group structures. Now, these are things which accountants are very good at playing with. I'm a professional chartered accountant. I mean, and one of the things I often say about my own profession is that we are really well-trained cheats. That is exactly what we set out to do when it comes to tax. Too often, I'm afraid, we look at what the law says and how we could work around that law without breaking it, without breaking our professional obligations, but nonetheless reducing the tax bills. Well, I didn't, but quite a lot do. I never did that. And seriously, that was never my approach. But I know full well that it was for lots of people. And I was in practice for nearly 20 years. Now, the point is, therefore, that take a big firm of accountants who have a client who doesn't want to pay tax. Are there going to be loopholes in this unless the OECD is very careful about their definitions and about the accounting requirements? Yeah, sure as heck there are. My belief is that we actually need to really spend a lot of time, civil society needs to invest a lot in time in working out how do we close those loopholes now. I would say the same. I mean, this might even be an article in the National this week if they're really unfortunate, because I haven't written my column yet. But it may be that this is again one of the games that Scotland needs to sort out. It might be a duller column. How to stop the abuse by multinational companies of tax rules to avoid paying tax, because that's the game we're going to play. Now, I just sincerely hope that they are going to be hiring some people. I'm not suggesting me, but people who actually understand A, accounts, and B, tax. Now, you'd think they're commonplace, but actually, by and large, when somebody qualifies as an accountant in their mid-ish 20s, they either choose a tax career or an accounting career if they're going to stay in professional practice. And once they've chosen that career, they never cross again. So we have people who understand accounting, and we have people who understand tax, but we have very few at places like the OECD or anywhere else who understand the interaction between the two. This time we need to get that interaction right, and stopping them creating loopholes which can be abused by the big firms is going to be critical to this working, because if we fail on that, frankly, they'll just drive coach and horses through this whole deal.
Yeah, I mean, I've seen it in multinationals who have been very creative, even at just making their profits disappear. Plenty of companies will make sure they buy their suppliers from a subsidiary who charges them exactly what needs to be charged to make them just about break even at the end of the year. So I could even see that happening as what this does is make profit margins reduce rather than taxes go up.
Yeah.
But Richard, you just said you didn't want the job, but if you got the job and you had the power and you had to redesign this global corporation tax, what would it look like?
Look, if I had the job, look, come on, if I was offered it, I'd take it. So let's not pretend otherwise. I guess I would. Would I like to be involved in the negotiations if I get the chance? Yeah, I'd actually quite like to do that too. Why? Because I think it's a really important thing that we do get this right. And I say I've got the experience of doing it once. I probably could add value again. But what would I want? First of all, I've already mentioned some of the things I want. I would like this to apply to all multinational companies, not a select few. Because the evidence is, and I've done quite a lot of research around this, it's pretty techie stuff, but I've done it. And I know that large companies are misallocating their profits to get a tax advantage. So let's not pretend it's just tech companies and it's just banks or whatever else. We know that this goes right across the board. And there are companies who are good and clean and honest. I'm not disputing it, by the way. I also think there are genuinely good companies out there. I'm not a total anti-capitalist or anything else here. I'm a chartered accountant who has run real businesses, and I'm happy to say I have. And I'm not saying that they're all wrong, but there are those who abuse. So I want all companies in so we can beat the cheats wherever they arise, not just in tech. So that's number one. All companies, and no limits as to size, get these formulas right. Work on a formula basis, allocate the profits, not on the basis of how you can structure your group, how many subsidiaries you can create in different countries, how you can play accounting tricks. No, where is your real economic activity? And the best indicators of that, and I think this is pretty universally agreed again, is where your sales are, where your people are, where your assets are, the real things you use to create business. So I would want to work on that basis, a genuine country by country basis. I would then want the information in the public domain. Now, this is really important to me. I mean, there are a number of real problems in tax and accounting. I'm doing some research right now. I'm asking you a very simple question of accounts and saying, do they add up? Now, yeah, that might sound a really daft question to ask. Of a large company's accounts, sure, of course they add up. But actually, when I come to tax, I've discovered, for example, they don't. I mean, there's a very simple formula that should work in a set of accounts for a large multinational company. Take how much they owe in tax at the beginning of the year, add on the tax charge, take off the tax paid. You should come to the closing tax liability. No, you don't. You never do. And why don't you? And I've been in correspondence with some companies about this research that I'm doing, which will be published. And they are a bit angry with me when I raise these sorts of questions. They really don't like me saying, could you please explain what the missing entries are? And some of them, are coming back with some really big missing entries, and some of them aren't explaining anything, but the accounts still don't add up. So all cards face up on the table is the next thing that I would want. Publish your accounts. Tell us where the tax charges are. Tell us where your profits are. Give us the data in an easy to read format so we know exactly what you're doing, how much tax you're paying where, so we can work out if you're being fair and honest and upright with us, because that's what we expect. And in a new world, by the way, of ESG investing, ESG, environmental social governance investment, which is really important now inside the investment community, lots of people are choosing to save their money this way. And I would recommend it. I mean, I believe in it. People are saying, well, is tax haven activity really consistent with good governance? Is not paying a tax consistent with, this ESG objective? So I think there's going to be a really big commercial pressure on them to be open and honest and accountable in this way as well. But that I would have. And then then I would say to the tax authorities as well, tell us how you're working with each other, so that there has to be openness about the interaction between tax authorities, because some tax authorities are really good at cooperating with others and others are not. I mean, I did once see a data sharing agreement between two tax authorities where the non-cooperative tax authority clearly generated all the data on a computer, and then they printed it out, and then they turned that into a PDF, and then they sent the PDF in a way that it could not be scan read back into a computer, to make sure that basically the data that they shared was completely unusable. It was, of course, a tax haven that was the non-cooperative jurisdiction, and I won't name which one of the UK's crown dependencies it was, but that is the sort of thing that does sometimes happen. And so we are looking at, are there cooperative countries and non-cooperative countries here as well? So, I basically would be looking at a system for all countries, all companies, with openness and transparency running throughout it, and with a higher effective tax rate, minimum tax rate. As a minimum, I would be setting it at 20%, not less than 20%, which is 80% of the average OECD tax rate now, and happens to be the same as the UK current. And I know things are different in Scotland, and I'm sorry about the guy who's making lots of noise outside the window right now. But obviously tax rates vary slightly between different countries in the UK now, but 20% or so is our minimum income tax rate.
Yes.
And we need to have something which is at least that as a minimum corporation tax rate. Otherwise, bluntly, we're getting an unfair result. We're also even going to create, of course, massive incentives to incorporate companies for individuals in all of the UK, including Scotland, which is going to undermine our local tax takes. And that's no good either. So I'm really talking about a level playing field approach to this, which will guarantee that the right tax is paid in the right place at the right time by the right company, and that we can all see that that has happened, which is important to our confidence in the tax systems and to our confidence in the business community, and that they're playing fair with us. And actually, let's be blunt, that they are the right people to be custodians of our pension incomes as well, because that's what a lot of them are.
Fantastic, Richard. And if Rishi Sunak happens to be listening, there's your briefing for the negotiations coming up. Richard, that's a wonderful note to end on. I can't agree more with the sentiment behind it. Thank you for coming on to the podcast. It's been a fascinating chat. I've learned a lot. Just to finish up, as I always do, just a reminder that Commonweal is an organisation that is entirely funded by folk like yourselves, who give us a £5 or a £10 a month. We don't have government funding. We don't have multinationals throwing their profits behind us. We don't even have adverts on our website. So if you want to support the podcast, if you want to support the policies that we produce, if you want to see more papers like the papers that Richard has written for us in previous years, again, I'll have links to them in the description. Please consider signing up as a donor. If you're already a donor, thank you for your support. You are the people who make this happen. I hope you've enjoyed this show. I certainly have. And we'll speak to you all again next week.